Good afternoon and welcome back, everybody, to Schwab Coaching for our next topic, trading breakout patterns. I'm your host, Kevin Horner. Thank you all for joining me this afternoon. Excited to get down to business with all of you. Say hi to my friend Cameron May in the chat, everybody. He's going to keep an eye on questions and comments that come through in the chat, which I may be unable to get to. Of course, I will truly keep an eye on it as well. I like to see the discourse going on in the chat, but I also try to answer your questions in the moment as we work through things. And of course, today we're going to look at a number of symbols that may be in potential setups for breakouts or breakdowns. And that might require you to provide your own input, maybe helping us decide which of these securities we consider for a potential example trade or two. So we'll get to that with all of you today. Before we do that, though, I want to remind you to follow Cameron and me on X. You can follow Cam at Cameron May CS, and I, of course, am at Kevin Horner CS. And if today's content's helpful for you, if you like the discussion and details we offer, please make sure to hit that thumbs up down below for us to boost this particular segment in the algorithm. Always a help to do just that. So thanks, everybody, for being here. Now, I'll remind you that our discussion, of course, is exclusively for your information and education only. We do not recommend or make a recommendation, rather, for any particular approach or strategy to trading the market, and we definitely don't make recommendations on the directionality. And all of our trading today will be examples only, of course. Further, remember that options are not appropriate for all investors. They do carry a higher level of risk and are not suitable for all. You want to be familiar with the characteristics and risks of standardized options. You do need to be approved on an account-by-account basis at Schwab in order to trade options. So make sure you've gone through the requisite steps to do that before you're ready to place those trades. And lastly, you know that we trade quite a bit here on technical analysis. We utilize that as a piece of our puzzle in building out our trades. Remember to consider technical analysis complementary in nature, not to be relied upon for on its own exclusively for decision making. So please keep that in mind as well. And I'll hit the last one here on this one: past performance, never a guarantee of any future results, of course. All right. So with that, let's just jump on into what's happening with the S&P 500, which is where we will start today. We're going to go through a quick review of the S&P and the NASDAQ, and then we're going to look at the example portfolio, hitting up a number of our key details, key investments that we've attempted previously. We've had some adjustments along the way. We've moved out of a couple of trades, and we'll look at all of that with you here today. So the S&P 500 got a little bit of a weak day yesterday. Now we've managed to hold the low we created yesterday with today's price action. So for the meantime, bulls remain relatively optimistic here, it would seem. As you can see, we talked in Trader Talk this morning about the importance of maybe holding yesterday's low as a low today. Well, it's played out thus far in that fashion. We would feel a little bit better if we could work our way further up yesterday's candle, but we're not going to complain about keeping it a green day thus far. If we want to take a peek on the shorter term side of things, we can look at this 5-minute intraday bar chart or intraday candlesticks. We'll notice that we just now took out the pivot point on the day, a level below which we have traded for the entire day thus far. So that is somewhat notable in a short-term scenario here, because the implication could be that now that we've achieved the pivot point, we may very well have an opportunity for a little bit more bullishness throughout the remainder of the day. The two key levels worth monitoring obviously now become that pivot point and that 20-period exponential moving average. You'll notice that yesterday, if we go back 2 days, let's go back to Monday, when we were above that exponential moving average, it was pretty evident we had a nice upside bullish day. We got below it middle of the morning there yesterday and stayed below it. So from a very short-term standpoint, the downtrend stayed and utilized the 20-day exponential moving average as resistance. Now today, that seems to have flipped over a little bit. We'll see if we can hold these pivot levels heading into the final 3 hours of the session here today. Pivot points, in terms of getting these added to your platform, these are just a traditional study I add them on the intra-period charts, though here in Thinkorswim Desktop, you can add them over any time frame you choose. What you want to do is just come up to the beaker and into your studies on the left, you can search simply for pivot, and they're going to appear right here. So this is the one we're looking for, pivot points. And then I'll just provide you a little additional context. All these is just giving you the view of what essentially is the average price from yesterday's price action, incorporating the open, the high, the low, and the close. And that's what the pivot point is in purple. The R1 level, the S1 level, first areas of resistance, they are derivatives of that pivot point. And these levels can occasionally act as short-term support or short-term resistance. But one of my big reminders as it relates to all things in the shorter term scenario is the shorter the time frame you're working with, the less reliable our signals become. So we must bear that in mind. And as of course, when trading, we always incorporate our risk, well-defined risk strategies to ensure comfort with our process. So that's a way that some traders do this. This used to be the pivot point concept and calculations utilized like this used to be done manually by the traders on the floor as they would try and gain an understanding of where they expect the market and any individual instrument to be on the subsequent day. So they used to do this manually. Thankfully, we've got these wonderful computers to do it for us nowadays. So that's the detail there on the pivots. Let's look at the NASDAQ here briefly, and then we'll get into what's happening in our example portfolio. We've had a little bout with weakness here this morning following through on yesterday's aggressive sell-off due to what we had in the way of semiconductor weakness, brought us down to the 20-day moving average today. A lot of bulls are going to make note of the fact that we basically tested the 20-day and have rallied off of it. That lengthy tail tells us just that, right? That we saw buyers coming in at that level such that it brought us back to 20,160, where we were down as low as 20,022 earlier today. If we look at that on the 5 minutes, you'll see our low got okay, so let me just bring this in briefly. What is that line in there for, Kevin? Well, that line was from Trader Talk this morning, and I said at the time, one way that some traders will do this is they'll just take the level they think can be supportive in the daily chart, make note of it. We did so at 20,020 points. That's the level of the index here, the NASDAQ 100. And I said, let's just put a line there and see if we can get any learnings from that throughout the day, because that could be the level off of which we bounce. And it turns out I put that line in and then we haven't tested it. We became close, but we haven't tested it. Missed it by about 16 points according to the short-term low thus far. That doesn't mean we couldn't revisit, couldn't be right back there. But at this moment, the amount of buying at that level certainly looks a little better than it did when we spoke during Trader Talk. Clearly, if we could push this higher and through the pivot point for today, that's going to look a lot more bullish for a number of reasons, not the least of which is what it would do to this candle here, which would then turn green. And if it were a day where it not only turned green, but had no tail at the top, that would tell us that we have then closed, not just on a bullish day, but closed at our highs of that day. That would be subsequently considered bullish as well. So we have plenty of things we could be hoping for here in the NASDAQ 100. By no means does that tell us that it's going to go that way, but that's what bullish traders might be eyeballing here on the NASDAQ today. All right, so let's take a look at one of the trades that we got taken out of. And I wanted to start off with this one because it's a wonderful reminder, not just of why we utilize exit strategies, defined risk strategies with things like stop orders, for example, but it's a great reminder that we can always learn something when we get stopped out of a position. So we're going to look at Pfizer here. Now, we've been talking a little bit about Pfizer because it's been an improving chart. We've tested the 200-day moving average as both resistance and support here of late. And let me get rid of some of these lines for us, and then I'm going to apply the trade details that are going to let us know when we started our trades here in Pfizer. So I'm going to go into my gear. I'm going to sell it to show trades. This is just under the general tab. So the very first time that you put your, you click on the gear for this, put you in the trades. Okay, so we got long back in here at 28.73. And our thought process was, hey, we've had an opportunity after having tested support, moving off of it. We felt like we could validate the 200-day moving average as a longer range of support. And so we said, all right, we'll go ahead and put ourselves in this one at 28.73 as we did. And then recently, we raised the stop. We moved this as we saw this, what could have been a breakout day. We thought we had a validated breakout. And so what did we do? We raised our stop from beneath the 200-day moving average up into this vicinity. Now, let's go and see exactly how this worked out. If we go into my monitor tab, and we're already on Pfizer because I've got it linked with my chart here. We're just looking back the last 2 months. Here's the visual on it. We placed it at 28.73. We got stopped out at 28.93. If I want to see the order history, I can get the details. So I had Pfizer as a stop at 28.93. So we had to trade through that to get our market order to sell. Well, the low of the day that we sold, everybody, was 28.85. That means that if I would have just given it another 10 cents of wiggle room, we would not have been stopped out of the position. And as you can see, now Pfizer is maybe back in gear, right? So a couple of takeaways. Number one, did I error in my assessment of where I could place the stop? Potentially. I mean, it's very easy to say that I should have made note that the level I selected was valid as a potential stop out. And yeah, it is always going to be that, right? When we incorporate stop orders, we recognize there's a chance this will occur. And the difference was, I probably didn't adhere directly to something like the average true range. So for example, the 50-day moving average on this day, 29.04. And maybe I want to take a look at the ATR, and the ATR is 60 cents. So I would need to come below the 50-day moving average amount by 60, maybe 61 cents. So if the 50-day is 29.04, come beneath that by 60 cents, that's going to put me at 28.54, right? So 28.54, guess what? I'm still in the position. Okay, doesn't mean that's going to work every time, but I would have maintained had I used the average true range below what I dictated as support or detailed as support. I would have maintained the Pfizer example trade here. Okay, so that's number one consideration. Could I have done something different? Absolutely. Could have stuck in the position. Secondarily, what about what has occurred since we got stopped out? Now, how many of you have been stopped out like this only to watch the next 2 days do what it has done, and you just sit there and say, yeah, I'm done. I got stopped out. I'm angry about it. I'm mad. I don't like it. I'm going to have to learn from it, but man, I'll tell you what, I was wrong. Therefore, I can't get back in. Well, some of you are going to say that that's exactly how you approach this. And you know what? You're not alone. I can tell you, I too have been there. However, looking at this trade, since that successful test of the 50-day moving average, many traders would have used yesterday's price action and said, you know what? I still got to get back in. Yeah, maybe I got stopped out at a bad price. I should be back in the position because we have a high above the low day. And if I believe in all of this moving average detail and the action we've seen over the last 2+ weeks, then a trader very well could validate getting back in if they're comfortable with then setting risk again lower, right? So it happens to us all the time. Getting stopped out on a position is an occupational hazard. It is part of this game, okay? Now, the question becomes, what do we do differently? Do we change our process? Do we get better at it? Clearly, going forward, I need to learn to work with ATR, average true range, when setting my stops in all circumstances. I can't just willy-nilly raise my stop orders in hopes that things are going to maintain, because things like this happen. Okay, lots of great stuff here. Okay, you are all the same boat as me. I love to hear it. That, you know what that tells me? We're all traders. Okay, we are all traders. We're going to take it to our opportunities. We're going to get stopped out. The key difference is eliminating the emotions after the fact, not allowing a stop out like we got 2 days ago to keep me from believing in what I've seen on the chart or what I see on the chart, maybe more so today. In fact, a lot of this action over the last 2 days would be enough to validate it such that a trader says, yeah, I'm going to go for it again and put a stop below 28.80 now, right? So exactly. Villager, great point. Look at it as a new trade. Don't hate trade a position, right? Don't allow what occurred last time to dictate your feelings on the new one. Just get yourself back in if you believe that the trend has reasserted itself. And while this got stopped out, when you look at yesterday's action and today's follow through, you could certainly suggest that that is possible. In fact, I could give you a downtrend line right through here that would say that all of this action is merely testing support of that breakout level. Okay. So maybe now we have a well-defined position, could certainly replace this. In fact, I think we should. I think we just put it back on with a brand new stop and let's just see how it moves from here. We don't have to go back to the full 500 share position. Why don't we go consider maybe half of that? So we'll just do a 250 share long equity. We will not do it as an option trade. We'll just see if this is going to do what kind of we're getting out of the pattern here, right? That beautiful 200-day moving average, more than flattening out, showing you the indication that there's a bit of a shift in what's been going on here with Pfizer. So we'll just put on a new trade. We'll put a stop order in because that's how we manage our trades. So we're looking at under 28.80 for the stop. And let me build that real briefly, and then I'll remind you as we do this, our process. So we're going to go with just an exit, not a target just yet. So we'll just do a buy at market with a downside exit below yesterday's 2 days ago low. Let me get back to that. Let's see. So we said 28.80 or so. Yeah. So let's go 28.77. We can go a little bit lower than that. Let's do 28.76. Just a little bit of wiggle room, not a lot, but a little. Again, recognizing there's no guarantee here because we could easily be stopped out yet again. But we're going to go ahead and do this for 250. So we'll do just about half the trade that we were taking previous. Okay. And then the reminder on the stop order, as always, is that it's not a guarantee for execution price. Remember, the stop is going to trigger at our level, 28.70, and it then becomes a market order. The biggest takeaway here would be that you, of course, have the gap risk, right? We have a stop at 28.70, but if the stock closed anything above 28.70 today, and then tomorrow opened at anything below it, the opening trade below 28.70 would validate our trigger. So even if it opened at 20, unfortunately, that's the first trade that would validate our trigger. And then our market order is going to be pretty close to 20, not likely to be close to our stop at 28.76. So keep that in mind, everybody, okay? All right, so we're going to go ahead and send that off. And now we are protected. We've got a new trade in. Hopefully this one holds for us and we've got a shot to get through the prior high. And I just wanted to put that back on just from a brief discussion of stop orders, getting taken out of your trade based on a stop order, and of course the revisit of what did we learn about setting that stop order and what could we do differently. Now back to some breakout stuff here that I want to make sure to get to with you all today. How about a quick review of the actual example portfolio in here, everybody? We've got a couple of, I'm going to move this back into my equity position. Is okay. We got a couple of small option trades that we have recently put on in the last couple of weeks. One of which is this Huntington Bank. It is a very small spread order, buying the 14 long calls, selling 15s, trying to make the $1 discrepancy there. Not a huge trade for us, of course, right? But we've managed to be correct in that the price is through both strikes, through the long 14s and through the short 15. So we could choose to close this out for our $73 of profit, since we have managed to basically cap our upside here by having sold the 15 call. Of course, a trader who could choose to speculate, but what we were looking to do was reduce risk. So our outlay was lesser by putting a cap on our upside opportunity here. So we could choose to close this one out. If we took a quick look at this in the chart, because we are through resistance, this might be one where we just say, yeah, let's close this particular one. And if we like this from a breakout standpoint, we could place a brand new trade, everybody. And there's nothing wrong with that, because when I noticed the level we're trading at today, 1585, yesterday's high 1604, and the areas we've moved through most recently, this 15.5 level line probably means something to us, right? Let's go ahead and check out our weekly chart. All right. Maybe we've got something working here, everybody. So that first HBAN trade might have been limited in scope and potential, but when we look at this now, maybe we've got an opportunity for a wider spread situation. We could conceive, if this is a breakout, that we could potentially trade up to that prior high, and we could also look at resistance in the vicinity of the highs that are a little bit lower than that. So those would be maybe in this zone, and that looks like it's about 17. So we've got a couple of ways to go about this, but you know what? If we really want to stay optimistic, some traders would just say, yeah, I'm going to look at that $18 level, because if it's going to make a new 52-week high, maybe there's that would be the ledge against which we could build our spread, right? We might look at something like potentially something in the money, maybe that 15 call with a potential short call at the 18 level or the 17 level. You could even choose to split that up. Maybe you do, as an example, of course, just 10 contracts at 15 strike, and then you say sell 5 of those, sell 5 calls at a 17 strike and 5 more at another strike, maybe 18 or higher, if that's available to us. I'm not certain what we're looking at here. It looks like we do have the option of going out to dollar for each dollar of strike series here, everybody. We would probably want to go out to November for consideration. And our price levels, boy, they're just not very active, are they, everybody? Look at this. Even for 30 days out, our volume and our open interest is really limited over the 17 strike. So what I'm seeing here, maybe A, suggests that we probably don't necessarily need to consider more than the 17 strike, because the 18 strike's not going to give us anything but a limitation on our upside opportunity. And the 17s are only going to bring you maybe 15 to 20 cents, which would make the 15s cheaper by that amount, right? So if we locked into a $2 spread situation, it looks like it would cost us about $1 to $1.05. And that is entirely worth noting. Mike comments that the earnings could absolutely invalidate any of a move. You're entirely accurate, Mike. Earnings here appear to be coming tomorrow. They'll be before market open. So that's one way to think about this, everybody. We are trading at highs. We have a trend trade that could be a breakout. And many traders don't want to step in front of a trade in advance of earnings. By the same token, even though this has broken to the upside, earnings could be considered positive and you still get a pullback in the stock. The implied volatility may be a little bit higher here than normal. In fact, let's see about adding in IV just to see if there's a significant shift. Doesn't look like it's terribly high here. Let's see, because for sure it was just I'm not finding it. All right. Well, I got to be honest, everybody. I thought for sure I'd be able to find the implied volatility line. I'm sorry, it's not there in my study set, so I'm not going to add it there. Let's go. Let's consider this, everybody. Let's put this one on as a potential quick trade, like a week-long trade. So like if we come back next week, we would probably only stick with it for about that window with the earnings announcement in play here, right? Earnings coming tomorrow. But building the potential $2 spread may very well make sense if you believe in a breakout. And that's the class, of course, is a breakout class. But we are acknowledging earnings are here, and we have to pay attention to that. All right. Thank you, guys. I'm seeing you maybe helping me out. Let me see. IMP. There it is. Thank you, guys. I knew it was in there. So let's just quickly look at implied volatility. Is it as high as it was, last time? It's actually higher than last time when we had earnings. Earnings back here showed it pretty high as well. So yeah, you're getting a little bit of a juiced up premium here. And that might be why the 17 is actually bringing any kind of return here. So maybe what we look at is a quick example incorporating the 15 call and the 17 call. So limiting us to a $2 spread scenario, buying the 15s. And why would we consider buying the 15s? One of the reasons is that higher delta here. Everybody notice the delta column I've added, it's added here in this particular breakdown. 72-cent delta. The delta, again, two ways that traders might consider the delta. As a ratio, 0.72, could be considered 72% likelihood that this particular strike price, the 15 call for expiration on November 15th, would be in the money at expiration day. That's 72% likelihood of in the money at expiration. That's one option of looking at it, one way to consider it. The other is the percentage by which the contract will move for a $1 move in the underlying stock. So the 15 call, in theory, would go up by 72 cents if Huntington Bank moved from 1588 to 1688. Okay? So that's one way to look at that as well. Two general calculations or concepts. And when you're thinking about it from a standpoint of trying to take advantage of upside move, sure, you want potentially to utilize a delta that's going to get you more dollar for dollar move in the contract relative to the underlying security. So that's why some traders would lean into the 15 call. If you feel like you need a little bit more juice out of it, you might lean into the 14 call. But as you can see, it's going to cost you a bit more, right? So for our purposes in this example, let's just use the 15. I'm going to left click on that. And then I'm going to go to the 17 strike, and I'm going to hold down my control button, left click on the bid, and it's then going to populate down below for me. And it looks like the net is $1. And I like to try to keep risk tolerance in this class, in the vicinity of about $500. So we could go for as many as 5 contracts here. So we are looking at a $2 wide spread for 5 contracts at $1 a piece. So our net cost would be about $500 plus our commissions on a per contract basis. And then looking at the breakdown here, having sold the 17, our limitation will be to delivering stock at 17 if it's above 17 at expiration. So that's the concept, at least, on this particular trade, and hopefully that works in the favor. But this is one where we could revisit shortly hereafter, looking at it a week from today, perhaps, to see about potentially closing that one out in the hopes that it goes in our favor. The good news is, if it goes against us, we have a maximum outlay of our $500. That becomes our maximum loss scenario on the trade, everybody. So if you look at it and say, yeah, 500 is too much, but I'm comfortable losing $200, this is where we drop the contract amount from 5 down to 2, for example. But again, always think about your maximum loss comfort zone. And my encouragement as it relates to options is really just to think about it from a standpoint of what happens if these contracts expire worthless, and say not that I want to invest 500 and then if it drops down in value from 5 to only 200, I'll then sell them and move on. My thought is, if you're comfortable losing $300 before moving on, why not just invest $300 and give the options the opportunity to move for you, and just admit hey, whatever I put on the table could become worthless. If you think about it like that, you'll probably find yourself buying fewer contracts and maybe allowing the opportunity to go through the expiration window here. Naresh, I'm only suggesting that we're trading it with the knowledge that we have earnings on deck. In this case, maybe for those of you who could be in an example trade like this around tomorrow's earnings, you might look to close it out tomorrow. In our class segment, though, we're going to look to close it out in a week at the earliest because we only reconvene on a week-to-week basis. Not everybody's going to be comfortable trading around an earnings window like this. And of course, when we trade in example manners, we're not recommending that you do so either. It's merely an example of how some traders might go about it. Nothing more than that. So let's go ahead and send that one off. And there we go. We've got a live order to buy the 15s, sell the 17s, lock ourselves into a $2 spread. We'll see if that works out. I did see a lot of notes about those stops. Appreciate that. You're all big believers in some of the same things that we are, right? Raising our stops, never lowering our stops. We do the math in advance so that we know where we have risk and we know how many shares we can comfortably own or how many dollars we can comfortably devote to any one individual trade. So very good stuff here. Thanks for all of that. I see we've got a survey opportunity. Always love the surveys, everybody. If you could take the 60 to 90 seconds, just click that link and it'll open a browser window for you. And then after the segment here, you can get right back to that browser and let us know your thoughts. Those come directly to me. I'd be happy to hear from you. Love to hear when you've got ideas that can be brought to the table for this particular class. That's great stuff as well. Okay, so we've got a new trade placed here. We've reviewed the example portfolio. Let me see if I've got other notes about, covered the stop order fail. Let's look at Walmart and see if we can make an adjustment here. We've got a trade that's working up. We're up 20% nearly. Is this move to a level where we can raise the stop? It's getting there, isn't it? Let me see. We can eliminate some of this stuff here. TR. Go. So some traders would say that we've broken this, and as such, they would look to raise the stop order. They might want to do just that. Our entrance is way back here at 68. So we've been raising the stops here, everybody. 50-day is where our current stop resides. It's about 3 points away from the 20-day moving average, which is where our next level might reside. And given what we just learned about average true range, keeping us in Pfizer, could have kept us in Pfizer. It didn't because I didn't use it. It's kind of silly of me. But what do you say we use ATR and let's come beneath the 20-day, which is today, 80.26, and we will come beneath the 20-day by $1.12. All right, so 80.26 minus 1.12 gives us 79.14. So that basically that allows us to raise our stop by 2 points, giving us an effort to maintain or capture an additional, because we're working with 25 shares, an additional $50 of our profit situation. And I know for a lot of us, that's not excitable. But you know what? That's part of why that position probably has been able to maintain in this account, because it is a small position. The up and down movements on a day-to-day, week-to-week basis are having a negligible impact on the portfolio, right? Not having a big move, but the percentage of return is fantastic. Who doesn't like a 20% return in 3 months, 3.5, almost 4 months? So really good move. So let's just kick that up 2 points. What did I say? 79.14. So we're just going to kick it to about 79.04. All right. So there we are. We just raised that stop. And if we get stopped out, so be it. That's fine. It's okay to get stopped out. Making a decision after the fact is a whole different ballgame, but at least we are working to capitalize on our upside moves and lock in our profits. Of course, we can only lock them in by virtue of owning puts, but we are raising our stops to increase the likelihood of a proper exit strategy here. Okay, so there's Walmart. Now, my notes suggest that we've got one more to look at. Fox. Take a quick peek at Fox. We've been talking about this one because of the trend against the 50-day moving average. Our stop is well below the 50-day right now. not really a need. Where would we be looking to raise the stop on this one, everybody? It's on a further breakout. Moves to new highs would be the instance when a trader might think about raising this stop. Right now, the stop is appropriately below the 50-day. By some measure, it looks like the measure could be about the average true range. But if we can get through the upside here, we're going to see that we've got a limit up above us at 40. What do I have that? 43. So we've got a limit order to sell at 43. We can raise the stop on a breakout to below the 20-day moving average, maybe, if you believe that that's going to start trending. But just make note, the 20-day has been porous along the way, meaning we have frequently traded below it and had to test the 50 days. So if we raise our stop to below the 20, we're increasing the likelihood of being stopped out. Okay. If that's okay, beautiful. No problem if you're comfy with that. If you're not comfy with that, then we maybe maintain our current level and we just give it more time. Okay. How about some new stuff, everybody? I got a couple of intriguing breakout opportunities that I came across in the scan tab, and I thought I could just highlight for you a couple of ways to do this. One of the main thoughts that a trader who's a trend trader looking for stocks that are continuing new highs or continuing breakdowns, continuing new lows, you can start from, if you've not built your own lists yet, or you've not been monitoring our segment here and working from the potential bearish list, potential bullish lists that I've been building, you can start by scanning within, let me just show you here, loading the scan query from public and going to, how about new yearly highs or new yearly lows, which is what I've started with. So scanning new yearly highs in the S&P 500 today specifically. So this is a automatic scan. This is in the public side, everybody. So under the scan tab, go to load scan query, go to public, and you'll find them all right here. New yearly highs, new yearly lows. Now, you don't have to be as broad in that approach, right? We have it started in the S&P 500, which I have told it. If you do this the first time, it's going to say all stocks. So we got a lot in the all stocks. But I told it, show me S&P 500 specifically. Now, I could be even more detailed if I wanted. What if we just said a couple of areas that I do know are working? Financials have broken out in many cases, as has, we've seen a breakout in industrials. What if I went to and just said incorporate industry of financials exclusively? So I'm looking at financials that are in the S&P 500 that are at new highs. Hit scan, and I change that list from 46 to 16. Okay. Now, that's one way to go about it. Not suggesting that that's the only way, but I just wanted to point out the thought here is fairly simple. Stocks making new highs. Everybody likes stocks making new highs. What happens beyond that is you need to give a stock that's made a new high maybe a window of time to consolidate or build a little sideways price action, maybe build a bull flag for you that would then allow you to participate, right? And sometimes you need to start from those stocks making new highs, place them on a watch list, and check them every day so that you're keeping track of that new trend, right? So let's just look at one of them that I've pegged, admittedly, pre-class, which was MasterCard here, moving through to new highs, 512. Well, this has actually happened over the last 3 days. Look at this. Nice little ascending triangle off of that last low, right? And the depth of that, we can just cheat. We don't have to be, too detailed here. Let's just cheat and draw the line. Looks to me to be about 4% or just shy of about 20 points. So I'll take that line, add it to the breakout, and then that tells us where we might see this particular run lose its steam or take a pause. Tells us there's still maybe 10 points up here, right? So some traders might have tried to take this trade on Monday on the breakout, yesterday on the breakout. Today is day 3 above the breakout. So perhaps you're a waiter for the Horner rule. You're looking for some validation in the form of time having passed. So maybe MasterCard is that opportunity on a confirmed day 3 breakout today, which is a little bit intriguing for a trader here, right? Doesn't have to get to our target, but if it did, that would be fantastic, as could a continuation of this move followed by the eventual throwback to the same breakout level around 502, right? So a couple of ways to note that and a couple of ways to give thought to potentially trading in MasterCard here. We can always go back to the weekly to make sure that there's nothing that we've missed here. But I'll tell you what, when you look at this one on a weekly chart, there's nothing on the weekly that changes your view much from the daily, is there? It looks like a pretty well-defined breakout, but on the weekly longer run chart, that breakout may have occurred even further back, maybe about a month ago almost already, 3 weeks already, where if you were just kind of keeping a close eye on this, yeah, that might have been a wonderful opportunity. Given that move has already been 30 points, you know what? This is going to have to make it to my potential bullishness watch list, because it feels like while our upside is still there, our risk reward right now is a little bit inverted because while there's blue sky above us, we could certainly take a very small position in terms of percentage, right? So maybe that's the trade. Maybe if we say, well, we would ultimately love to own 10 shares of, which would be a $5,000 position. If we'd like to own 10, but we're not convinced that it's only upside from here, maybe we start small and see if we can get ourselves to be able to add to the position after a throwback and a retest, whether that retest is somewhere around here or maybe somewhere in the neighborhood of the 50-day moving average. So instead, why don't we just do, say, a very small 5-share trade, and then that gives us something to keep an eye on. We can do a deep stop order way down here at about 480, which would be just fine, but recognize that we are giving up a pretty healthy move. The good news is if we give up as much as, let's see, that's about 30 points. Well, on 5 shares, that's only going to cost us $150 if it were to fall like that, right? So that's manageable. That is not a terrible scenario. It is inverted risk versus reward potentially, but at least from the share standpoint, it'll make it easier. Yeah, and absolutely. Could we consider options? Sure. The only drawback to considering options in any case, of course, is the time frame associated with it, right? By owning the shares, you don't have to concern yourself with time. And when you own options, you always have to concern yourself with time, right? Because every option contract has a finite life. So let's do a small 5-share position with a stop under 480. And we could use the ATR on this about 6.5, which would be from 483 and change. How about 477? LCV, long call vertical there, Maligator. There you go. So just the idea of what we just did actually with that Huntington bake trade. Long call at the near strike, short call at the higher strike, locking into the spread scenario here, capping your upside with a long call vertical approach like that, vertical spread. Okay, so let's go ahead and do that. We're going to do buy. We're going to do a buy custom with the stop, like I mentioned. All right, so we're going to do just 5 shares. There we go. All right, and 477 as my good till canceled stop zone. We remember that 477 is by no means a guarantee in price action or guarantee to be executed at that level. So we are going to buy just 5 shares for $2,500, approximately $2,487. Stop if it gets down there at 477. So, whoops, I'm not trying to do a limit. So this is why I always read these things, everybody. Make sure I get my order details proper. We're buying at market, and then we've got a stop order thereafter. So our execution is going to be 25.57 approximately, but we can't guarantee that because market order doesn't guarantee price. So go ahead and hit send on that. And we are in the trade, and there's our stop well below the 50-day moving average. My hope is that this continues pushing. If we get that throwback here, say over the course of the next week or 2 weeks at 500 or so, that might present us an area where we would look to add to this potential breakout. But And then if we add to the breakout, then we got to address that stop order, right? Make sure that that stop order incorporates all of the shares we have, and maybe it gives us a chance to raise that stop even further. All right. Okay, so yeah, Thea, let me just mention once more. The scan that we used here, scanning for new yearly highs, this is a public, not personal scan. So this is available without any scripting. So if you are, as long as you're in the live Thinkorswim desktop, you will find it here, load scan query and public, and it is simply new yearly highs or new yearly lows. There, everybody. Okay, and then last note, survey once more. Thanks to Cameron for getting that in the chat for us. Take a moment and follow Cameron and me on X at Cameron May, CS at Kevin Horner, CS. Hit that thumbs up button down below for us, everybody. Like I said, it really helps us out in the YouTube algorithm. And I want to thank you for your questions, your comments, and certainly for taking the 60 seconds to let me know your thoughts in the survey. It helps me out a lot. I do try to bring to you all an understanding of your questions, your comments, your ideas to this segment. So it does help, and I try to incorporate those as best I can. I hope you all have a great rest of your Wednesday. More to come from us here on the Schwab YouTube coaching channel. So check the calendar, everybody. Have a great rest of your day. I look forward to seeing you all again real soon.